For the first time since 2008, Ray Dalio just pinpointed a time frame for the next financial crisis 2 days ago. The clock starts this week, 18 months. Here's exactly what he said and exactly what it means for your money. $7 trillion is what the federal government will spend this year. $5 trillion is what it will collect. That's a $2 trillion shortfall every single year with no resolution in sight. On May 3rd, in writing, Ray Dalio publicly declared that the next 18 months represent the most dangerous fiscal stretch in modern American economic history. 2 weeks from today, Jerome Powell exits the Federal Reserve. Kevin Walsh steps in under direct pressure from the White House to slash rates aggressively. Republicans, in Dalio's own words, will likely lose the House in November, sparking major clashes, including impeachments and investigations. Three of the most powerful forces in the American economy are colliding over the next 18 months, and we're only in week one. Ray Dalio oversees $124 billion he called the 2008 crash. He spent decades examining every major monetary shift across 500 years of economic history. What he just said publicly is the same message he's giving his clients privately. $7 trillion out, $5 trillion, and 18 months on the clock, 2 weeks until Powell is gone. If you don't grasp what's converging right now, exactly what Dalio said this week, and exactly what to do about it before this window shuts, you'll end up on the losing side of the biggest macro repositioning in 15 years. Subscribe right now because the back half of this video breaks down the specific tickers, the exact instruments accessible through any standard brokerage account that Dalio's framework points to for this 18-month stretch. Let's start with the math, because once you understand the $7 trillion versus $5 trillion gap, the urgency stops being emotional and becomes purely mathematical. The federal government currently spends roughly $7 trillion a year and brings in roughly $5 trillion. That's about 40% overspending annually. To cover that gap, the Treasury issues new debt, bonds promising future dollars at a fixed rate. Somebody has to buy those bonds. Historically, three groups have absorbed U.S. debt at scale: American households and pension funds, domestic banks and corporations, and foreign central banks, with China, Japan, and Europe as the biggest players. That third group is now pulling back in real time. China has been a consistent net seller of U.S. treasuries for several quarters running. Japan has trimmed its holdings. European central banks are shifting away from dollar reserves. The Strait of Hormuz situation, the wider geopolitical shifts, the tension with Iran, it all points the same direction. Foreign appetite for U.S. debt at the prices the U.S. needs is fading right when the U.S. needs it most. $7 trillion spent, $5 trillion earned, $2 trillion in new debt needing buyers, and the biggest historical buyers are stepping back. When demand for any asset weakens as supply grows, only one outcome follows: prices drop. For Treasury bonds, falling prices mean climbing yields. Climbing yields mean higher borrowing costs everywhere. Mortgages, corporate debt, auto loans, and federal interest payments themselves, which already top $1 trillion a year, surpassing the defense budget for the first time ever. In a country carrying $90 trillion in total debt, even a modest repricing has enormous ripple effects. A 1% shift in average yields adds nearly $1 trillion to yearly interest costs over time. The math feeds on itself. Pull out your phone right now, open your banking app, check the interest rate on your savings account, check the yield on any money market fund you hold. Whatever number you see, jot it down, because that figure will either be the floor of what's coming or the ceiling of what you missed. $7 trillion, $5 trillion. That gap isn't closing by itself. Now connect that math to the second event unfolding this month. 2 weeks from today, Jerome Powell, who's chaired the Federal Reserve for several years, steps down. His likely replacement is Kevin Walsh, a former Fed governor who served through the 2008 crisis. Walsh has historically leaned hawkish on inflation. But here's the political backdrop that flips everything. The Trump administration has said openly, repeatedly, that it wants the incoming Fed chair to cut rates, in the president's own words, by a lot. Ray Dalio tackled this head-on April 27th in a CNBC interview that aired the day before Walsh's nomination was officially confirmed. Dalio's exact words: "You wouldn't cut rates now. You'd lose your credibility. The Federal Reserve would lose its credibility, especially now." 2 weeks from today, that decision-maker changes. 2 weeks from today, the institution most responsible for protecting the dollar's purchasing power will be led by someone under maximum political pressure to do the very thing Dalio just said would wreck its credibility. Why does Fed credibility matter this much? Because the entire U.S. financial system rests on one core belief: that the Federal Reserve will defend the dollar, that monetary policy follows economic data rather than political pressure. The instant that belief cracks, the instant investors and foreign governments decide the Fed is being politically steered to inflate away U.S. debt, two things happen at once. The dollar weakens and demand for long-duration U.S. Treasuries collapses. The $2 trillion annual gap suddenly can't find buyers at sustainable prices. The cycle speeds up. This is precisely the scenario Dalio has studied for 30 years in his work on the big cycle. When governments lose monetary credibility, the fallout plays out over 12 to 36 months. Currency depreciation, accelerating inflation, capital flight into hard assets, real rates falling even as nominal rates climb. This pattern repeats with striking consistency across every major economy that's crossed this line throughout 500 years of recorded history. And here's the specific phrase Dalio used in his April 28 Fortune interview that almost no one is repeating: "We are certainly in a stagflationary period." His words, not a forecast, a diagnosis of the present. Stagflation is the nightmare combination of sluggish growth, sticky inflation, and a weakening labor market. It's the worst possible macro environment because the Fed's standard toolkit makes one problem worse while fixing the other. Cut rates to boost growth, and you fuel inflation. Hold rates to fight inflation, and you risk recession. The incoming Fed chair walks straight into this trap 2 weeks from today, with the president demanding aggressive cuts. Now here's the third converging force, the one linking financial pressure to political pressure in a way almost nobody is discussing. In his May 3rd statement, Dalio explicitly predicted Republicans will lose the House in the November 2026 midterms. He went further, saying he expects this to trigger, in his exact words, great conflicts including impeachments, investigations, and so on. Translate that into financial terms. Dalio is forecasting that the U.S. will enter the most fiscally fragile 18 months in modern history, alongside a gridlocked Congress, a politically pressured Fed, and a shrinking foreign creditor base. This is the part viewers need to feel, not just hear. These three vulnerabilities aren't separate risks. They're three doors into the same room. The $7 trillion versus $5 trillion fiscal problem can't be fixed without political consensus. Political consensus can't happen amid impeachment proceedings. Without consensus, the full weight falls on the Federal Reserve. And if the Fed is being politically pushed to cut rates while inflation stays sticky, the only mathematical way out is currency debasement, the dollar losing value against everything that can't be printed. Let me show you what this exact setup looked like the last time it happened, because the parallel isn't loose, it's mathematically precise. In 1978, the federal government was running deficits to fund post-Vietnam military buildup and expanded social programs. Inflation had climbed past 9%. The Federal Reserve was mid-transition, with President Carter having installed G. William Miller as chair. Miller faced intense political pressure to keep policy loose despite rising inflation. He caved. He chose accommodation over credibility. The dollar collapsed. Gold ran from $180 an ounce past $850 in 18 months, a 400% surge. The S&P 500 lost roughly 40% of its real purchasing power against gold over that same stretch. Holders of long-duration treasury bonds lost more than half their real wealth. By 1979, things had deteriorated so badly that Carter replaced Miller with Paul Volcker, who pushed rates to 20% to crush inflation. That stretch wiped out an entire generation of conservative savers who believed holding dollars in a bank account was the safe move. They were wrong. What looked safe wasn't. Real safety meant protecting purchasing power against the political incentive to inflate. This same setup showed up in 1971, when Nixon severed the dollar's gold convertibility under fiscal strain from Vietnam. Gold went from $35 to $200 in 30 months. It showed up again in 2008, when monetary stimulus was used to paper over structural debt problems. Gold climbed from $700 to nearly $1,900 over 36 months. That same setup is showing up right now in May 2026, with Powell leaving in 2 weeks, a $7 trillion versus $5 trillion fiscal gap that's structurally unsolvable, and political conflict that's mathematically all but guaranteed per Dalio's own forecast. Bridgewater Associates, the firm Dalio founded, has documented this pattern empirically. Portions of their internal research, now public, show that across every post-war monetary transition, where these three conditions converged at once, gold averaged annual real returns above 25% during the following 18-month window. Energy companies with structural pricing power averaged real returns above 20%. Long-duration nominal bonds averaged real losses exceeding 15% a year. Cash sitting in checking and savings accounts lost 5 to 12% annually in real terms. This isn't theory, it's measured, repeated, and documented across three major historical episodes. If you haven't hit subscribe yet, do it now, because the rest of this video lays out the specific framework, the exact tickers and allocation logic that Dalio's research points to for this 18-month window we just entered. 2 weeks until Powell leaves, 18 months until the political crisis. Dalio forecast reaches its peak. The window is open right now, and most retail investors have no idea what's converging. Here's the framework. Across every monetary transition, Dalio has studied 4 asset categories have consistently outperformed during this exact window. When fiscal stress meets monetary credibility, loss meets political gridlock. These aren't theoretical picks. They're the data-backed winners across centuries of monetary history. The first category is gold and physical precious metals. The easiest entry point is GLD, the SPDR Gold Trust, available in any standard brokerage account. For larger positions, IAU from iShares carries a lower expense ratio. For exposure outside the financial system entirely, allocated physical gold storage through reputable services like the Perth Mint or Bullion Vault offers ownership without counterparty risk. Central banks have been the largest net buyers of gold over the past 12 months, over 1,000 metric tons in a single year, the fastest sustained pace in 50 years. They're not buying because gold is rising, they're buying because they see what's converging. Sovereign wealth funds are doing the same. Institutional capital is flowing into gold right now, ahead of the price action that will follow. The second category is energy companies with structural pricing power. The easiest entry point is XLE, the Energy Select Sector SPDR Fund, offering diversified exposure to the largest integrated U.S. energy producers. For more concentrated exposure to exploration and production, consider XOP for dividend-focused energy exposure. Consider AMLP, the Alerian MLP ETF. When monetary policy is politically forced into accommodation, while supply chains face geopolitical disruption, energy becomes the most reliable inflation pass-through asset in the equity market. Energy producers aren't hurt by rising oil prices. They essentially are the rising oil prices. During the 1973 OPEC shock, when the S&P 500 lost 48% peak to trough, integrated energy companies posted some of the strongest returns of any sector. The same pattern repeated in 2022, when energy gained over 60% while tech fell 30%. The third category is short-duration fixed income and treasury inflation-protected securities. The easiest TIPS entry point is SHP, the Schwab US TIPS ETF with a very low expense ratio. For shorter duration TIPS, consider VTIP from Vanguard, holding TIPS maturing in 5 years or less. For pure short-duration treasury exposure, consider BIL, the SPDR Bloomberg 1-3-month T-bill ETF. There are 2 completely different categories of fixed income here, and confusing them in this environment is one of the costliest mistakes you can make. Long-duration bonds get crushed by rising inflation and rising rates. In 2022, long-duration bond funds lost 20 to 30% of their value. People thought they held the safe part of their portfolio. Instead, they held the most exposed part. Short-duration instruments and TIPS behave completely differently. Short bonds mature quickly and reset at higher rates. TIPS adjust their principal automatically as inflation climbs. In a stagflation environment with eroding monetary credibility, this category is the structural fix. The fourth category, the one Dalio has emphasized most over the past 6 months, is international diversification away from concentrated US dollar exposure. The easiest entry point is VXUS, the Vanguard Total International Stock ETF, covering developed and emerging markets outside the US. For pure emerging market exposure, consider VWO from Vanguard or EMXC from iShares. For markets Dalio has specifically flagged, consider EWJ for Japan, VGK for Europe, and FXI for large-cap Chinese equities. Dalio explicitly noted that capital is structurally rebalancing away from US assets. In 2025, the MSCI Emerging Markets Index returned 33%, double the S&P 500 16%. European, UK, Japanese, and select Chinese equities all outperformed US equities in dollar terms. Dalio's exact words: there were big shifts in flows, values, and in turn wealth away from the US, and what is happening will probably lead to more rebalancing and diversifying. This isn't a temporary blip, it's an early signal of structural rebalancing as global capital reacts to the exact conditions converging right now. Pull up your brokerage account right now. Look at your allocation. What share sits in US equities concentrated in tech and growth? What share sits in gold or precious metals? What share sits in energy? What share sits in short duration, fixed income, or TIPS? What share sits in international or emerging market equities? Most retail investors, looking honestly, will find they're almost entirely concentrated in the categories that historically underperformed during this exact monetary transition. That concentration isn't safety, it's exposure. Drop your current allocation percentages in the comments below. Just the numbers. Behavioral research is clear on this. Publicly stating a financial position significantly raises the odds you actually act on it. Naming what you have is the first step toward changing it. Here's the specific portfolio framework Dalio's research points to for this 18-month window. These aren't stock picks, they're structural positioning ratios. With $10,000 in investable capital, the breakdown looks roughly like this: about 15% in gold via GLD, about 25% in energy via XLE, about 15 to 20% in TIPS via SAHP or short duration treasuries via bill, about 15% in international diversification via VXUS, with the remainder in your existing diversified US base. At this size, the goal isn't optimization, it's establishing the structural pattern before it becomes mandatory. But with $25,000, the same percentages scale directly, the math doesn't change with portfolio size, only the granularity of execution changes. With $25,000, you can hold individual energy names alongside the ETF. What with $100,000, you can add a modest physical gold allocation and allocated storage outside the financial system, build a more diversified international position across regions using ETFs like VGK, EWJ, and VWO, and run a quarterly rebalancing discipline that forces you to systematically sell strength and buy weakness without emotion, overriding the plan. The exact tickers matter less than the framework itself. The framework is what protects you through an 18-month window where the dollar faces structural pressure, the Fed faces political pressure, and the political system faces impeachment pressure. Now pull it all together. 2 weeks from today, Jerome Powell leaves. Kevin Walsh takes over under maximum political pressure to cut rates aggressively. Ray Dalio just publicly said doing so would wreck Federal Reserve credibility. The federal government keeps spending $7 trillion a year while collecting $5 trillion. Foreign demand for the resulting $2 trillion in annual debt issuance keeps structurally weakening. We're already in a stagflationary period, by Dalio's own assessment. The midterms in November will likely produce a political configuration that triggers impeachment proceedings, sidelining Congress as a functional player in managing the fiscal trajectory. 18 months, $7 trillion versus $5 trillion. 2 weeks until Powell leaves. The window opened this week. The historical pattern is unmistakable. In every major monetary transition over the past 100+ years, those who positioned correctly in the specific 18-month window before the transition completed compounded wealth at multiples of those who positioned during or after. The gap between when conditions become visible and when price action confirms the thesis is short, usually 6 to 12 months. We're in week 1. The savers who held cash in 1978 had access to the same information everyone else did. The deficits were public. Carter's pressure on Miller was public. Inflation was public. Gold was already moving. They didn't act because the system told them their bank accounts were safe. By the time inflation became impossible to ignore, gold had already run from $180 to over $400. The window had already closed. Their real purchasing power was cut in half over the following 4 years, not because they made a bad investment, but because they trusted the dollar at the exact moment it was being politically pressured to lose value. You're not those savers. You have the framework they didn't have. You have access to instruments they didn't have. GLD, XLE, SpeechHB, VXUS, all available through any standard brokerage account in 15 minutes. You have a real-time signal they never got. Ray Dalio publicly stating 2 days ago that the 18-month window has just opened. There are 2 kinds of people watching this video: those who will look at their portfolio in the next 72 hours and make at least one concrete change toward this framework, and those who will close this video feeling informed and do exactly what they were doing before. If this video shifted how you think about what's unfolding right now, hit like. Drop your current allocation percentages in the comments below. Writing it publicly significantly boosts follow-through. Subscribe and turn on notifications. The next video breaks down the specific energy companies within XLE that Dalio's framework flags as the strongest pricing power positions right now, with exact ticker selection logic and rebalancing timing. The data is public. $7 trillion in spending, $5 trillion in revenue, $90 trillion in total debt. 2 weeks until Powell leaves, a Fed transition under maximum political pressure, an election cycle Dalio expects to trigger a constitutional confrontation, a foreign creditor base already retreating, a stagflationary period he's already declared in writing. 2 weeks, 18 months, $7 trillion versus $5 trillion. The window is open, the pattern is documented, the instruments are accessible. Don't be most people. Most people watch videos like this, nod along, understand the logic, and do nothing. Go.